Good afternoon, Saturday, November 22nd, just past 4 o'clock. Got the USC Oregon game on in the background. USC just scored right before I started recording this. I am a sports junkie, a stock market junkie, or a better way to say it is I'm passionate about those things. I stayed up last night. I watched the Florida State game. Uh, sorry for Brooksy and Plummer. I thought Florida State they just had bad luck there on the special teams. That punt, they hit their own player and bounced back, to and then they punted again and they fumbled. So I just thought it was bad luck there. NC State had good luck. Um, Watched Oklahoma today, so congrats to Allen Anu. They beat Missouri. They look like they're bound for the playoff in the CFP, and then we got some games tonight. I actually watched. I love basketball too. I played a lot of basketball growing up. I love the just how the five players interact, how the game flows, and I love Nikola Jokic, the Joker from the Denver Nuggets. Just because how he plays, he makes the right basketball play, a lot like LeBron James. They played the Houston Rockets last night. I stayed up late watching that. I shouldn't have because sleep is so important, but I just got watching, and then like a fly to honey, or you know a butterfly to a flower. I start going on these things, and I keep going. Same thing with the stocks. I This morning I was going. I am working on my E&P update, which is long delayed, and I worked on some this morning, and I started doing 2026 free cash flow estimates for Antero, EQT, and EXE, which are Antero and EQT are two of my top five, and EXE I own that as well because I owned Southwestern for a long time. Merged with Chesapeake. Chesapeake we owned two, but was sold out larger to go to Antero, which was the right move. But then we ended up, Chesapeake reorganized, and then they merged with Southwestern. And so anyway, but if you model free cash flow on the 2026 strip, it's about I have Antero at 13% right now, and then EQT and EXE like at 12% free cash flow yields for 2026. So I was like, those are pretty good, and I actually think the strip could go higher, especially if we get the cold start to the winter. So then I was like, well, how does that compare? Because I'm thinking about what to buy for my cousin's portfolio, the family DCA portfolio. So, well, before I jump into that, let me do my housekeeping. Kai and I, we got mixed up yesterday and just got busy, both of us. I ended up going to the gym late, the sauna late. And so we're going to push our podcast back to next week. Also, from a housekeeping standpoint, Eric Nuttall, I never know how to say his name correctly. I think it's Nuttall. I saw that he had a filing where he added rig Transocean to his portfolio. I like rig a lot. The reason I made the oil room, headlined by rig, I said that's the ultimate capital cycle play, the offshore drillers. So it was interesting that Nuttall added that. I also want to follow up on the sauna. We had some feedback discussion in our live chat group at the Contrarian. Yeah, the sauna is good for a lot of reasons, including I didn't mention it sweats out toxic metals, which is really good. There's some bad to it too. Now I'm 48. I've got my own brood of kids, my own crew of kids. But if you're looking to have children, I think it's bad for your heating up your will kill sperm. So be careful of that if you're a guy, and you're in the child, looking to have children. So we had a nice discussion about that. A little teaser. I mean, retail stocks really had a good day Friday. The market bounced back some. RH was up almost 10%. VFC, which we had bought in the FAMGCA portfolio a couple months ago, was up 10.9%. Cracker Barrel was up 4.4%. Crocs was up 4%. There's been some stronger reports of retail spending. Last week, I highlighted Williams Sonoma in the video thing I did on RH. They actually beat, and then Gap beat, and Ross Stores had good performance. So it looks like the consumer, and then Turbo, Aaron in our group, he posted something that said, hey, there's weakness in Target, but that's not really indicative of the broader retail sector. So, and you're seeing some signs of strength there, which adds to the Atlanta Fed GDP 4.2% estimate. So there does, and the Dodge Momentum Index, there looks like there's a construction boom, but it looks like the retail sector is starting to revive a little bit. I think part of why they also moved on Friday was that the Fed funds expectation of a rate cut went from like 39% to 72%, largely because of John Williams talking. I also think the labor market data that was delayed, even though it was stronger than expected, it didn't hurt. So those are just some housekeeping items. I'm going to shave my beard pretty soon. It's getting longer. So you'll see me on one of these next with the beard shaved. So going back to free cash flow. So um, again, Antero is around 13% for the 2026 strip by my calculations. EQT's in NEXE around 12. Crocs is 15% plus. Rig is 15% plus. Leggett and Platt is 15. I can actually model 15 to 20% for Leggett and Platt. Peabody is 15% plus, even with where the strip's at. And I think, obviously, I think met coal prices are going to go up. Newmont, if you think of Newmont, it's 91 billion market cap right now. At 3,600 gold, I calculated about 7 billion in free cash flow. So it's like a 7.7% free cash flow yield at 3,600 gold. Gold's above that now, above 4,000. I think gold's going to pull back. So you have to do some of that calculation. You can use the strip for natural gas, or you can use the strip for met coal. You can just use the market price for gold. I discounted that a little bit for Newmont. Newmont, could be 10% plus if gold stays here. So VFC is around 10%. RH is around 10%. Pan American Silver, 8 to 10%. Cliff, 7%. LYB, the chemical company, around 7%. And then I had CCOI, we're looking at that with Anderson, kind of sparked a discussion with their picture from Morocco in our group. I've got that around 7%, but those free cash flow estimates have come down, so there's some variability. Interestingly, Cracker Barrel's fiscal year ends in July. So they're kind of like RH, it's off a little bit. For this fiscal year, it's kind of, their adjusted EBITDA is just, 20, 30 million above their CapEx. Next year, Cracker Barrel could have a 20% free cash flow yield if you take the midpoint of kind of estimate. So it could be higher than that too if they get to their high end. So I'm going to write an article, that highlights some of this, so you don't have to remember it. But just as I think what I'm going to buy for my cousin's portfolio, and then even for myself, I wanted to kind of have that as a barometer. And again, you can't just use that in isolation, because something like Transocean, I wrote an article earlier this year. I'll link it to the piece I write, on these free cash flows, but it talked about what the replacement value was. And so, Transocean's selling below its tangible book value. So it kind of checks two of those boxes. You're getting it at a discount to the asset value, replacement value, and it's also generating free cash flow. I think something like Leggett and Platt, same thing. You could even argue that the breakup value of Leggett and Platt is significantly higher than where it is now. But at least here, they are generating free cash flow, and then they can use that to, buy back stock or do other things. So, Mosaic. Sandra and I have been talking about Mosaic. Potash was like my second biggest position in 2010. I've had Mosaic at that time. I've had some of the fertilizer players. I've kept an eye on them. There's a big divergence between, it's not Potash anymore, it's Nutrien. They merged with the company, but between Nutrien and Mosaic this year, Mosaic's free cash flow yield for 2026 is around 12%. So that's kind of interesting too. That's another one to put on our list. So, that was my, obviously like everybody, I have family, older kids coming back, family. My mom's coming, for Thanksgiving. We've got people around the house. So I ended up, I should have been doing other things, but I spent like, you know, hours watching sports last night, and then today, multiple hours digging into free cash flow estimates, thinking about that. So time just has kind of melted away. I wanted to, while I had it, fresh in my mind, I wanted to go ahead and keep my streak going. I thought, I don't know if I'm going to be able to do the podcast through the holidays, with the holiday week, but it does help. It's providing me an incentive here, and I'm a creature of habit, like most people are. So I want to keep the streak going as long as I can. But if it doesn't come out, I got busy with kids or family or holidays or something. So, um, the another thing I want to mention. Well, the S&P put volume was the second highest reading in here, on Friday. So I think that's a good sign that there's a bounce in the cards potentially. I mean, I always could cascade lower, but there's some real fear in the market. Obviously, Bitcoin has really corrected. It's hit that $82,000 target, then a new kind of outline for us, maybe faster than he even thought. He said he wasn't going to buy anything before Thanksgiving. We kind of got there, So I wouldn't be surprised, because a lot of the secondary names, things that were very speculative, the largest year to date gainers, excuse me, they have corrected very strongly. I do think people will use that bounce, to raise liquidity, because you have to imagine if you're a fund manager right now, if you're a money manager, you're looking at your year-end bonus, it's sliding away from you a little bit, right? And so there's going to be a incentive to go ahead and wind things down. So I think you'll see rallies, be sold into, is my guess. Could we rally through the year end? It's possible still. I mean, obviously there's a Ukraine-Russia peace deal on the horizon, but there's been a lot of damage done internally in the market. But I thought it was interesting that there was a lot of put volume on the SPDR, S&P 500 ETF, the SPY. Natural gas, I want to just do a brief overview. And basically, with natural gas, it's, we've experienced it, a lot of it, the last 10 years, and it's been one of our primary sources of returns. It was one of our primary sources of pain, in 17, 18, 19, as we continue to study it. But natural gas, it was, you look at the bubbles of capital investment, and the shale era was actually a bubble. And, what happened is there was a lot of money, and we saw it with Antero, from 2010 to 2020, they spent between $2 to $3 billion a year in capex, and then that came down. Maintenance capex actually got down around $500 or $600 million. They've been able to grow much more efficiently. I still think, remember that article reviewing Mother Fracker, which said that all shale plays aren't the same. There's a competitive advantage just because of the core Marcellus. It is the closest thing to conventional production that we have in the shale era. And a lot of conventional production is now, it's, the shale era dominates. Conventional production is, that has a slow decline rate, is a very small percentage of the overall production profile. So those Northeast Marcellus, Southwest Marcellus, which are probably the best shale plays in the country, probably the world, they have very high initial well production rates, and the decline rates are much better too. And so from a capex standpoint, they're very efficient. But Antero has been able to, and all the producers in these core areas of the best natural gas acreage, they've been able to go back to maintenance capex. But it's interesting when you look in aggregate what the companies in aggregate were losing to build out those shale plays, and then they started making money in obviously 2021, 2022, as that dynamic flipped and they went back to maintenance capex. But there's still, Antero was different because it had made $5 billion from hedging. A lot of them had not done that, but Antero did that to build out their production profile. But in aggregate, they're just now, they haven't recouped their entire investment capital. They're still negative. And so the players are much more disciplined. And it's relevant. It ties in a lot of ways to the AI bubble, because the AI bubble, which I believe is a bubble, you're seeing the most capex there that I've ever seen in any capital expenditure. Ultimately, that's going to drag down returns, and that's what it did in shale. Shale's still just recovering from that, and then in addition, to because remember the Appalachia didn't really produce, it was nominal amounts of natural gas and natural gas liquids and oil. Then they went to the largest producer in the U.S. Right, so it's roughly today it's like 35% of natural gas production. Appalachia, so it was nothing. The Permian is maybe 20% or so. Those are just rough numbers. And the Permian was all the gas, the dry gas was associated gas. So there was, it was driven by oil, and obviously oil rigs are down a lot year over year. So not only, did you have this CapEx boom where you had to work through this era of low returns, but then if you're the shale producers of, the gas plays, you've had to compete with the associated byproduct gas from the Permian principally. So you went through this low return era for a long time. And what it's done is it's forced discipline. So, and I'm going to tie this in really quickly to what's happening in all the capex that's being spent for AI. And what you're seeing here is there's competition, and I think that there's people are trying to get their hands around, like Google, because they're using their own processors that are built by Broadcom, so AVGO. Broadcom makes about $1 billion a quarter from Google, so nothing like what NVIDIA is making. NVIDIA is like something like 75% gross margins. So the risk to NVIDIA is that Google doesn't have to use their chips. They have kind of a closed computing stack, and if Google can lower the cost of AI compute, it will essentially force the competitors like OpenAI to bring their costs down. And what that will do, similar to the shale era, you're going to be in an environment where these companies, you're not going to get the returns that they envisioned, because it's going to be more of a commodity. And I think Google wants that for advertising. So Google could win, and the risk would be NVIDIA has kind of been the only company that's really profited from this. They've been the proverbial, they're selling the picks and shovels to the gold miners. Well, it may be different now. So we'll get more into that. I just want to give a quick update on what I've been working on, and outline. You'll see an article that kind of leads with some of those free cash flow numbers. I'm going to get back to watching football, back to my family. It's beautiful here in the Midwest. 50. We've had a lot of rainy, cold weather, but it's 50s, low 50s, but kind of sunny. Great day to be outside, to do things. I love college football. It's winding down here, so I'm going to enjoy the last of it and enjoy family this week. Hope everybody listening to this gets that same opportunity, and even if you're by yourself, just take in the moment, enjoy the moment. And, I'm appreciative and thankful for each day for everybody in our group. And I hope you guys all have a good Saturday. Take care.